Well, I have the pleasure of introducing to you today Stephen Schwartzman, who has kindly agreed to lecture our class. Mr. Schwartzman graduated from Yale in 1969. He was at Davenport College. Do we have any Davenport people here? Any? A few, not a lot. He graduated then from Harvard Business School in 1972. He worked at Lehman Brothers as, I don't know if it was his first job or one of his first jobs, and became managing director at Lehman Brothers at age 31. And he became head of their global mergers and acquisitions team. In 1985, Mr. Schwartzman, with Peter Peterson, founded the Blackstone Group, which has become the lead manager of alternative assets. In some sense, what he does and what David Swenson does, whom we had heard from earlier this semester, is similar. They're both looking at unusual and different investment assets. And they are both very successful in doing this. Mr. Schwartzman's firm has had a return on private equity investments of 23% a year on average for the last 20 years. This is a little bit in excess of David Swenson, but I think we have to put them both as remarkable investors. In the real estate group at Blackstone, they've had 30% a year for the last 15 years. And this is after fees. Blackstone Group has been very much in the news recently. It just came out that they are apparently going to be buying $12.5 billion of leveraged loans from Citigroup at a steep discount. And so apparently they've seen a profit opportunity there, or they're supporting our economy from the ravages of the subprime crisis. Also in the news, China has announced that it plans to buy $3 billion stake in Blackstone Group as its first effort to diversify its $1.2 trillion of foreign exchange reserves. So the Blackstone Group was picked by the Chinese government as the most fitting place for it to put some of its reserves. So with that, I will leave it to Mr. Schwartzman, who will speak for a while.
Thank you very much for coming out on what's a bit of a dreary, slightly rainy morning. When I was in an undergraduate, we wouldn't have gotten much of an attendance. People would have been sleeping in. So it's awful nice of you to be here. There are some dramatic differences from when I was an undergraduate and you are. One of the first differences is that this course wouldn't have existed because no one had an interest in finance at that time. It wasn't a particularly interesting time in the 1960s. The securities markets actually were regulated. Commissions were fixed on the New York Stock Exchange, so it was very difficult to find some way to compete. It was sort of a rigged system, if you will, and it wasn't open, and so there was very little to no interest, really, in finance. There really wasn't an SOM. School of Management at Yale at that point. Business generally was utterly unfashionable. We were in the midst of the Vietnam War, and business was sort of linked to the perception of that war because they supplied, certain types of war materials, and that was the most unfashionable thing that you could be involved with. So there was a very anti-business, non-existent finance orientation at the school, and obviously that's changed in the society generally with enormous differences. And as a result of when I grew up, I didn't even take an economics course at Yale. I frankly wasn't much good with math. I stopped in the 11th grade, and I think calculus was for me, that was way too much of a reach. So I'm more in the add, subtract, multiply, and divide kind of category, which worked and still does, quite well for me. And when I graduated, I was lucky enough to get a job at a firm that had just gone public. It was the first New York Stock Exchange firm that had just gone public. It was called Donaldson, Lufkin and Jenrette. And Bill Donaldson actually founded the School of Management after he left DLJ, and that was because this is a financial markets course. That was quite interesting for me because I didn't even know what common stock was when I graduated. Hopefully, you will have learned more in this course. And I went to DLJ. I couldn't read a financial statement, which is like going to a foreign country and not being able to speak a language. It was sort of hopeless. But one of the interesting experiences I had about which really, now that I'm a little bit older and can look backwards on financial markets, it was my first visit to a company. And DLJ basically was one of the first large institutional stock managers of pension fund assets and so forth. And I was allowed to go and interview a company. I'd never interviewed a company executive, and I read their annual report, and I went up to see this gentleman, and I sat there and I figured out all the things I'd want to know so that I could figure out whether I should buy his stock or invest in his company. And I went through my list of questions, and he wouldn't answer most of them. And I found it a very frustrating experience. And I went back to the office, and by the time I got back to the office, Dick Jenrette, who was president of the firm, had gotten an enraged phone call from this executive and called me into his office, and he said, "Geez, you made this man very angry." I said, "Well, how could I do that? I was just asking questions." And he wasn't answering them, so I just asked the question again. I couldn't quite understand why he wasn't answering me. He said, "Well, you were asking him things that he's not allowed to answer." I said, "What do you mean?" He said, "Well, you were asking him for inside information." I said, "Well, I don't know what inside information is. I'm just asking the question that I need to know the answer whether to buy the stock or not." And he said, "Well, Steve, there are all these rules of what you can ask somebody, and then if he tells you, then he has to tell everybody in the world, and that's just too cumbersome, and so that's why he didn't answer." I said, "Well, if he didn't answer, how in the world can you figure out what to do?" And I said, I'm not that smart. I need to have all relevant data. And he's the person who has it, so why won't he give it to me? And it became pretty clear that I was doing the wrong thing for a living. And in effect, that's the dilemma for people who want to buy liquid securities. And I decided very quickly this was a bad business, certainly a bad one for me, that I couldn't figure out how I could win that game, when somebody wouldn't fully share openly everything they knew. I guess if you were like a Summa with a good fashion sense, that's how you manage liquid securities and beat other people. It's not just what you know, it's a question of whether the rest of the world will buy into what you know and drive that security up. And so I basically retreated and went to Harvard Business School, where I figured maybe somebody will tell me how this game really works in a way that I can prosper in it. And that was a good experience for me. They basically taught you, and you're undergraduates, so you don't know what they're teaching you at a school like that, so I can explain it actually pretty clearly. It's basically they're teaching you that everything you do with a company has something else to do with that company, so that it's an integrated system. So that if you are trying to develop a product for sale, it would be good to know whether somebody wants it, right? So what happens actually in the real world is that sometimes people just get an interesting idea and they'll produce a product and nobody will want it. And if you integrate all the different kinds of knowledge in the company so that you're doing intelligent things, and I know this appears very elementary, you'll have a better company. That's sort of what they were teaching. And after they taught that for like 2 or 3 months, I sort of got it and thought about dropping out of school because it got a little repetitive, frankly. But I was convinced by my friend Dick Jenneret, who also thought about dropping out of Harvard Business School in December. It gets very cold in Boston and really miserable. And he was going to drop out and go and get a PhD in economics. I was going to drop out and go back to the real world. And he said that his staying on was a good thing and I should stay on. And so I did. And what I've sort of done for a career is try and solve that problem of my initial meeting, where people will, I want people to tell me what's really going on so I can figure out, whether what they're saying makes sense or doesn't make sense. And you can do that in the private equity business, which was sort of our largest business. And you could do that in the real estate business because you're allowed to get all that inside information if you're trying to buy a company with our rules and also the rules of other countries. If you sign a confidentiality agreement that you won't use that information for any purpose other than buying the company and putting a price on it, and then the shareholders get a chance to vote on whether they want the price that you give them. So to me that was like an answer to my conundrum of how could we get all the information and then figure out what to do with it, including improving the company. I'm sure you know something about private equity. If you read the general newspapers, I'll tell you basically what it is. Well, all we do is we buy companies, and that's the simplest thing we do. We do a lot of other things, but let's start with, we buy companies. We borrow money to buy those companies. Historically, it's been about $3 of debt for every $1 of equity. We then improve those companies, through a whole variety of, sort of managerial actions. And then those companies grow with the general economy. And let's say if they just grow at the regular rate of all companies, then if you're leveraged 3 to 1, you're going to earn a much better return. If you take a company and can accelerate its growth, so it's growing faster because you've improved it and you have 3 to 1 leverage, you'll get a way better return than any normal stock market kind of return. And that's sort of the model of what we do in that business. As Professor Shiller was saying, we've compounded after fees at 23%, but before fees, because we charge a 20% part of the profits of the deal goes back to the general partner, which is us. We actually earned around 31%, which from you being in a course like this, you'd see that's really pretty high, compared to a stock market average over a period, which would be around 11. And in real estate, where we do the same kind of thing, but real estate is an easier business because buildings don't talk. Managements of companies talk, and you have to figure out what they're saying. Companies are very complex. You have interesting competition. You have global competition. It's a complicated asset class. Real estate is very simple. I mean, there's buildings don't talk, and so you can't get misled by a building. They can't tell you something. They don't have a belief system, and it's just there. It's on the corner. It's in the middle of the block, and there are other buildings that either are getting built or planned, and you can figure out what the supply demand is for real estate in a much easier way, and because of that, our returns in real estate have been better because it's an easier asset class, and we've earned after fees 30% a year since we started, and before fees close to 40%. So this alternative asset class, if handled right, is really a much better way of earning money for investors, as well as the general partner, let's not forget us, than regular financial markets investing. That world has been started very small. When we started it, the institutions had less than 1% of their assets. It was like infinitesimal in the private equity side of the business. It's now up to about 4.5%. And the returns are so much higher, you'd wonder why people don't give us all their money on an asset allocation basis. And I actually still wonder why they don't, since we put most of our money in that, and we keep making more and more and outperforming, and it just takes the rest of the world apparently the equivalent of your lifetime to sort of figure out exactly what they should be doing, and I think the projections are that this should be growing at a lot faster rate, going into the future, and some institutions like Yale have private equity with around, I guess it's around 16-17%. It was up to 18 of their portfolio, and that's one of the reasons why Dave Swenson has done much better than regular money managers. Turning to a different subject, it's a financial markets course, and I thought it would be useful to talk to you a little bit about what's really going on in the real world, even though this course is being recorded, and whatever you say about the current moment turns out to be right or wrong, but it's just a current moment. It's such a fascinating one, and you all are, I guess, somewhere between 18 and 21 years old, probably 19 and 21. So you don't have the perspective to understand how really interesting and dangerous this current environment is. What's happened is that through an abnormal issuance of something called subprime securities. For nobody in this audience, certainly people watching, have probably own a house. And what happened is that in the late 90s, the government in Washington passed a law to encourage more low-income people being able to buy houses, and resulted, along with other factors, in an explosion of these types of loans. And in terms of loans, and Professor Shiller can correct me if I'm slightly off on this, but in the year 2002, of the total mortgage loans that were originated for houses, probably around 2 to 3% of them were subprime. And these are for people who don't have enough money to really pay normal principal or interest and expect their mortgage to be current, to not go into default. And by 2006, this had exploded to 30% of all the mortgages that were issued that year. When you go from 2 to 3% to 30%, this is an almost out-of-body experience, and to entice these people to take these loans, they actually would tell somebody, in the olden days when I was your age, to buy a house, you had to put up like 25% of the cost of the house. Sometimes you'd have to put up 20% of the cost of the house, and you can borrow 80%. These subprime loans, sometimes you only had to put up 3% of the cost of the house. Sometimes you didn't even have to put up anything. That makes it really affordable. And then you didn't have to pay any interest for 2 or 3 years. So you put up nothing and you paid nothing. So this led to a stampede of people who wanted this. And what's happening now is that the mortgage, the interest, which no one, a lot of these mortgages didn't have to pay, now 2 to 3 years later you have to pay it. And a lot of the people who didn't have the resources can't pay the mortgages. Those mortgages are defaulting. The issue that created all the problems in the financial system that you're reading about in the front page is that these mortgages were pooled in a new security. Imagine just sort of a jar where somebody threw in a few thousand of these mortgages and then put the lid on it. So they had these new securities, and what they did is they said, well, the first 83% of them must be really safe because mortgages basically hardly ever default. And they rated those, the rating agencies, which tell people how secure something is, rated this as a AAA security. In the world of finance, when you tell somebody that a security is AAA, they get rated all the way from AAAs down to CCCs. And CCC means something's about to blow up. And AAA means there's no possible chance you're ever going to lose your money. And so because 83% of this jar was rated, AAA, people bought this all over the world as if it was a security that could never, ever, ever default. And as you can see, these were basically mortgages made to low-income people who weren't even paying, in some cases, interest on it. And the chance that these were going to default was really sky high. Historians will go back and figure out why anybody would believe that these things could be AAA. But they did, and they were bought everywhere. So these securities became like American SARS. They were exported throughout the world, creating enormous problems for individual institutions, around the world. And in the United States, they've created what will be hundreds of billions of dollars of losses for the financial institutions. And as part of Sarbanes-Oxley, which was a law passed, after Enron and some other things, we've developed accounting procedures with something called, it's very technical, called FAS 157, which is called fair value accounting, which means before these defaults even happen, the fact that other people think they're going to happen results in the securities being worth less, and you have to take a loss based on that expected value. So the financial institutions were losing all this money without the defaults even happening or people knowing how bad it would be. And as a result of those large losses, the financial markets started losing confidence in some of the financial institutions, and different asset classes in those financial institutions, principally banks, started trading in a really bad way. People thought they were going to, be forced to sell some of those, and we had a variety of different asset classes ranging from municipal bonds, basically changing their value. People said, I don't want these anymore. There were hedge funds that owned those on leverage. So there were margin calls which forced those securities to be sold, which made them worth even less. That got the banks even more nervous. That resulted in higher rated securities being sold that were also on leverage. And what you had was like panic selling of securities rolling through. every element of the financial system as people desperately tried to get out of stuff before it would become worthless. And this type of rapid deleveraging resulted in downward valuations for all these securities, a lot of hedge funds going bankrupt, anyone with leverage borrowing more than 5 to 1 to carry some very secure real securities, not subprime, but government-oriented securities. Those institutions got into trouble. And what we've had is basically a melt in the financial markets where the banks have been so severely impacted that they have stopped lending to certain whole asset classes, particularly leverage lending, which we're involved with, as well as other areas. The costs of credit have gone up, sort of 3%, 4%, which doesn't sound like much to you, but it actually in the overall system is a lot. And what that's resulted in is a financial crisis. It's resulted in the Federal Reserve, who's the ultimate protector of the system, very quickly lowering interest rates, agreeing to lend huge amounts of money to the banking system, because banks are now not even lending money to each other. They're sufficiently scared about what's going on. And the Federal Reserve is saying, well, everybody can come to me and I'll lend you all money to keep you liquid so this whole system doesn't stop. Now, as it impacts regular people, is when the financial institutions go into a crisis like this and stop lending or reduce their lending of money, there's less money for regular people to borrow to go about their lives and businesses to get. And as that starts happening, an economy will slow down and go into recession, and that's what's happening in the United States. So for those of you who are graduating this year, your prospect of getting a job will be less than the people who graduated last year. And the people who graduated the year before had a much better deal than the ones that were graduating last year. And this is a problem that's a pretty pervasive one, and it will probably take longer to get out of this recession than other ones that we've had. And the implications of financial markets, which may sound like just sort of a dry academic course, this will also affect the outcome of presidential elections, among other things, because you'll see that from what presidential candidates started talking about 9 months ago, which is a lot of foreign policy, war in Iraq, what should we be doing about a variety of those issues, you'll see that by the time this election occurs, that the focus will be much more, and perhaps dominantly so, on the economy, on people defaulting and being thrown out of their houses, on what's happening to the economy generally. It's going to hit other things such as trade and the country being more populist, more protectionist, which also has negative implications because the United States right now is the largest debtor nation in the world. 10 years ago, we were the largest creditor. And when you're the largest debtor, that means you have to borrow money all the time from people in the outside world. And if we become more protectionist and outsiders basically say, look, these Americans are starting to not have an open world, and I'm worried that maybe I won't be able to get my money back, or they don't really want me to be part of their world, then there's the potential that they will invest less with us, which again will raise our cost of borrowing in financial markets, whether they're for treasuries or other types of things, which will have the effect of again slowing our economy. So you all are about to enter the world in a very, very, very interesting time. And the problems with our financial institutions are perhaps the greatest that we've had since the 1930s, in the era of the Great Depression, which is when my dad was sort of a young man, and he grew up in the 1930s, and anyone who did, would tell you that was just a disastrous economic time, because those financial institutions, as opposed to struggling the way ours are, and ours will ultimately be fine, those financial institutions collapsed because they didn't have the kind of sort of safeguards that the system has basically put into our system currently. We learned from the 1930s how to avoid a complete collapse of the financial institutions. But this is a trying time for these for the system, and the Federal Reserve is doing a really excellent job at sort of guaranteeing it. And if you read about the recent Bear Stearns crisis, which was front page of literally every newspaper in the world, where the Federal Reserve stepped in and basically provided sufficient guarantees and credit support so that this one institution wouldn't go bankrupt. And there were, it's a brokerage firm. Brokerage firms are not regulated by the Federal Reserve, and they don't have access to the borrowings of the Federal Reserve to protect them, which is, they're sort of outside the system. And the reason why the Federal Reserve went and did that is that the large brokerage firms, which don't have the same kind of regulation or the same kind of ultimate lender, literally have trillions and trillions of dollars of counterparty risk, sort of guarantees that they've given that they'll do something. And if they go bankrupt, they can't do it. And that leaves the system vulnerable to people expecting performance on things like credit default swaps and things that are too technical to actually explain to you at the moment. But there are so many trillions of dollars of those obligations that if they get into trouble, this isn't just like a subprime mortgage. These are in the trillions, and just credit default swaps are about $45 trillion, and the subprime mortgage losses will only be a few $100 billion. So the Fed was basically going in and saying, we can't take this risk to our overall system. And that's one reason why the stock market has gotten better, because the prospect of a collapse of the system has been really reduced. I wasn't trying to depress you on a early morning. The American system is enormously resilient, and there will be solutions that happen over time that will deal with this. But the impact of financial markets, which is your course, I'm just a visitor, is really driving the whole overall economy, and is affecting the global economy. The countries in Asia, China, India in particular, as large ones, will obviously sustain lower growth rates as a result of this financial markets problem here in the United States. You're seeing the UK having already slowed down, and this will probably, as it has historically, rolled into continental Europe and resulted in the whole world growing slower, higher unemployment, and people being adversely affected. So how financial markets work, how they're impacted, and what would have happened if these subprime mortgages wouldn't have been allowed to have been made from a regulatory point of view, and what would have happened if they were, instead of being rated AAA, they would have been rated single B. Hardly anybody would have bought them, and that would have controlled the expansion and the risk to the financial system. Historians will look back on it, and real people, not that historians aren't, but real practitioners will try and solve this problem by having different types of regulation so that you can't get into this kind of risk posture. So in any case, why don't we take some questions? That's an opening, and we can talk about anything you'd like to. Dare to be great? Yes?
Speak loud. I'm just sort of curious, maybe you can sort of case study format, take us through a deal, or maybe two deals, one that went great in your opinion, one that went very poorly, from source to exit.
The question was, can I take you through a good deal and a bad deal in, I assume, private equity, or, to show you how this works? A good deal, those are always more fun, by the way. A good deal, it was really our first deal. It was a company called U.S. Steel Corporation, which is sort of a big one. Was attacked by a corporate raider named Carl Icahn, who I think you have some familiarity with, and being a prior speaker. And the corporation didn't want to be taken over, and so they were trying to marshal cash to fight him off. And the way they chose to fight him off was by buying their own stock at a higher price to give their shareholders the equivalent of a really big dividend, but doing it by buying their stock, which gave them capital gains treatment. So they needed to get a bunch of money, so the way they thought about getting some money was to sell one of their big assets. And the asset they chose to sell was their railroads and barge lines and ore boats on the Great Lakes. And to make steel, for those of you who've never done it, it's a lot like cooking. You need a variety of different ingredients, and the ingredients, instead of just being carried into your house in a shopping bag, come in on a railroad because they're iron ore and coke and all these really heavy things. And in I guess around 1880, 1890, a fellow named Andrew Carnegie, who owned U.S. Steel, it was then called Carnegie Steel, built all these railroads to bring this stuff in. And so U.S. Steel, wanted to sell it, and they didn't want to lose control of it because they felt if that was a lifeline artery into their steel plants, where it brought in 100% of the raw materials to make steel and took out about 85-90% of the finished product, because steel is like really heavy, right? So you just can't carry it out and put it on a truck necessarily. It goes out by railroad also. That because this was an artery that went right into the company, and if we started overcharging for the railroad, they were worried that we would bankrupt the steel companies. We'd siphon off all the profit. So we did a partnership deal where we owned 51% of the railroads, in effect. They owned 49%, and we show you how excessive finance can get. It was I believe the deal was somewhere around $600 million, $700 million in 1980, 88, 89. So that's a lot more money today. We borrowed almost all the money. I think we put up like $15 or $20 million, so the leverage was huge. The business wasn't particularly a growth business; it was pretty stable. We bought it in the middle of a strike, so part of the art of what we did was guessing whether U.S. Steel would come back to the same production level that they were before. Our guess/analysis was correct. And every year, the profits from that company would be worth more than the amount of money that we invested in the equity. And so we ended up making 24 times our money in that deal in 12 years. So in our world, not the academic world, if you make 24 times your money in 12 years, this is regarded as a success. So that was a good one. Now a bad one shows you about a little bit about the the volatility and danger of sort of the currency markets. We in 19 guess it was 98 bought or it might have been 97 or 98 bought control of the second biggest cellular phone company in Argentina, which was an interesting place to be. I'm sure you all have one of these. If you don't have something more elegant, some other, sort of personal device, like one of these that can, get email, or it can, you can talk on it. You can almost, set it up as a disco. You can do almost anything with it. We bought this company for 8 times cash flow, which is not real high for a company that's growing very rapidly in what was called an emerging markets country. This particular country had its currency indexed to the dollar, so it was almost like investing in the United States, because what can go wrong? A rapidly growing country invested in dollars. We borrowed dollars to buy this company because in Argentina you couldn't borrow money for a long time. One of the great things about the United States financial markets is that you can borrow debt for long periods of time. And this looked to be a very low risk, rapidly growing situation where we were hopeful we were going to make 4 to 5 times our money. There was only one problem, that Argentina, the country, collapsed. I mean, literally collapsed. The linkage, which is called a peg to the dollar, turned out to be a most unfortunate thing. And the emerging markets, this is when you started with the Russian financial crisis, and this crisis, and you had an Asian financial crisis. It rolled through the whole world with currencies rapidly changing their values. All kinds of countries at risk of collapse. It got to Argentina, and the whole economy pulverized. It was like a depression, and they got off of their linkage to the dollar. Their currency became close to worth nothing, and then we had to pay our debt back in dollars with earnings in Argentina, which were like worth nothing, and we lost every cent, every dollar we invested in that investment, and even as we were going bankrupt, it was still a good company. So, in finance, bad things can happen to nice people, even when you think things through, you can have some really bad outcomes. We've had, obviously, if you have very high returns, you have wonderful stories, many more wonderful, stories than bad ones. We bought a chemical company called Celanese in about 2003, right after the recession was lifting. It was a company in Germany, but it had only 10% of its activities in Germany. It had about 60% of them in the United States. So it was really a U.S. company masquerading as a German company. The price-earnings multiples of German chemical companies were very low. The price-earnings companies of American companies were much higher. Not being entirely dim-witted, what we did was we changed the location of the company, the headquarters, from Germany to the United States. They also were, for some reason that we didn't completely understand, had 3 headquarters operations going, 2 in the United States, 1 in Germany. We closed 2 of those 3. We invested a lot more money in expansion as we were coming out of a recession. We leveraged the company pretty highly, and we made, I guess it was about 6 times our money in 2 years owning Celanese, which is on the New York Stock Exchange now, and it's a lovely company, wonderful company. And there are many stories of that type where we invest more money, move things around, borrow a lot of money, catch fundamentals as they're going up. And the good stories are really a lot of fun. We enjoy those, and so do our investors. So I gave you 2 winners and 1 loser instead of 1 and 1, because in our real estate business, we've probably, just to give you perspective, we've only lost money on 2 situations in our history out of about 160 investments. So the number of good stories to bad stories, I mean, this isn't like Las Vegas, where you end up as a net loser or it's a lot luck. Every time you do one of these things, you have a team of people working on it, some of whom are sort of in their sort of early 40s, who are usually partners, and then, each one of the firms like ours scales down in some kind of hierarchy, where you have managing directors and vice presidents and associates and analysts. The folks like yourself tend to get hired at firms like ours as analysts, and which means you do, statistical work and I guess they're called now models, on computer, which give us an idea that if any of the variables affecting these deals change, how will it affect the overall earnings of the company or cash flow of the company or our ability to service the debt of that company, and then we can figure out from doing that what price we'd want to pay for the company, how much debt we can safely put on it so that the business doesn't get in trouble. And now, this analyst program that firms like ours have and people all over Wall Street have is like a huge industry for people your age. This didn't exist when I was in college, and I'm actually not that old compared to you. I sort of think I'm almost the same age, a little older, but it's amazing having people like yourselves. I mean, in 2 years, you could be in my conference room, with all the rest of the team talking about a live deal and, putting in your 2 cents, of perception, or, whether you think something's a little more risky. What we do at our firm, whenever we're considering something, we always go around the table, ask everybody. So, we're not trying to intimidate anybody, but we figure that if somebody your age has been working on something and knows the numbers, sort of cold, you'll have some views. And it's always fun, particularly for me, to ask, because that's how you start the process of learning. Finance is a business that is an apprentice business. It's sort of like going back to the Middle Ages, right, where they had guilds. And you'd learn your business by apprenticing with somebody else who's already done it. There's a base level of knowledge that you have to have in finance before you can be creative. And the only way you get that is by working with other people who've already done it and are doing it. And people take enormous care when working with folks like yourself, in terms of making sure you get the right answer or not. What I'd say, which is different in the real world, as a visitor from the real world to you in the academic world, one of the real differences is, in the real world, there is only 1 grade for every project, which is the equivalent of a course, and that is an A grade. And the definition of an A isn't the same as in academics. In academics, you can get an A, and I don't know what Yale's current grading curve is now. You can get an A sometimes with a 90, you can get an A with a 92, you can get an A with 93, and that's sort of pretty good. That's an A. In our world, an A is 100. This was shocking to me because I wasn't a 100 kind of person. And my first project that I did, I just to give you an idea of the real need for excellence and perfection in what we do, I was assigned a project I worked on it really hard. I wrote something up that was like a term paper, which normally you only get to do one a year. In the real world, you get to do them every 2 to 3 weeks. And I submitted this thing to a gentleman named Herman Kahn, who was a partner at Lehman Brothers, an older partner at the time when I was doing it. And I sent it down to him, and he was waiting for this project. And I got a phone call about 3 hours later, and it sort of went like this. This is Herman Kahn calling. Is this Steve Schwarzman? And I said, yes, it is, Mr. Kahn. He said, I got your paper. There's a typo on page 43. Bang! And that is the only thing I ever heard from Herman Kahn. A slammed phone because a comma was in the wrong place on this piece of work. And I had really, struggled. And that's all I got. An angry man and a slammed phone. And I basically said, what kind of crazy world am I in? What is this about? And what I learned is that any piece of work that you did that wasn't completely correct, you got a version of Herman Kahn in your face, okay? And different people did it different ways, but this was a radically different world, the real world, in finance than I was used to. I was a major here in something that doesn't exist, I'm sure, anymore, a creature of the 1960s called culture and behavior. And what we did is we had an interdisciplinary major in psychology, sociology, biology, and anthropology. In other words, we studied how people thought and why they thought that way. I thought that was a pretty neat thing to be doing, and we had professors from each of those disciplines. We had 2 seminars a week. We had 8 students in the major, and we had 4 professors working with us all the time. So I was used to a little softer, more lovable world than finance. And so finance for me was shocking that people would have to have everything correct all the time. And at your level, what you'll be doing, that's sort of what it is. I mean, there's no alternative. People are nice; they'll help you get there, but there's absolutely no flexibility in terms of getting perfect scores. Now, once you do that, I'm giving you a little career advice here. That you do that for about 2 years or 3 years, and then after that, you can start being more creative, and finance can be really creative, interesting, problem-solving business where it's global, it's fun. I mean, in my last 2 weeks, where have I been? Let's see. Certainly in New Haven now. I was in Bahrain, Kuwait, Saudi Arabia, Abu Dhabi, Dubai, Cambodia, Korea, Ireland, and Germany. It's actually really interesting. And you meet people all over the world. You get to see how they think about issues, how their financial systems and their economies work. During that trip, I met heads of countries, head of financial institutions. You're trying to figure out, really the most complex stuff in the world, which is how all these systems work and how they interact, and ultimately what you will do in an individual situation based upon this immense flow of knowledge and data and cultural differences. I miss China and India on this trip, but we get them on other trips. And it's really, finance done appropriately is a wonderful lifetime learning, ever-changing exciting kind of business. It's not like, sort of selling socks to a department store. This is really fascinating business. It never stays the same. You have so many different people in so many different countries making so many different kinds of decisions that you, as one decision maker in that enormously complicated matrix, the chance that you're going to get it right is only because you're absorbing as much information as you can from every place and trying to thread the needle to make a correct decision. So it's a lot of fun. So any of you who go from this course into being a practitioner, which is sort of what I am in the real world, it happens to have historically been quite financially rewarding, which I guess is like I used to think that was a really good thing, until the U.S. is like reevaluating exactly what it thinks about success. But it's basically a good thing, and it's fascinating. And I would encourage you, if you have an interest in it, to pursue it. Yes. Can you speak up a little? Yes. Okay, it was a question about carried interest being taxed at a lower rate. Next question is, what asset class do we think is going to have really high returns over the next 5 years? On the carried interest question, this is something that it's been pretty well surfaced. There are a bunch of arguments from different sides of the political spectrum on this. Folks like ourselves who have had carried interest taxed at capital gains rates since the 1930s are sort of wondering where the whole discussion is coming from. In other words, this has been going on for longer than I've been alive. This has been a capital gains treatment item. The way carried interest works is that we get a 20% share of the profits of any investment over some type of hurdle rate, which is a minimum return. In our case, usually it's around 8%. To get this carried interest, we have to invest significant monies, in our funds, which is totally unlike normal compensation. Most people to get, some people in the government want to characterize this as normal compensation, ordinary income. People who get ordinary income just work and they get it. They normally don't invest millions of dollars for the opportunity to get their salary. We also have to, if we don't make a certain minimum return and we've gotten some of this carried interest, by the time a whole fund's over, we have to pay the carried interest back. Most people who earn ordinary income don't pay back their income after they've gotten it. Carried interest basically comes out of splitting the profits from a partnership where it's sort of quite normal for a working partner to get more of a deal than just a passive investor in whether it's somebody just in a family, somebody works in the business, and somebody else in the family puts up the money to buy part of the business. Usually the person working in the business gets more. So we sort of look at this as sort of an issue that's now in the political world, and it will be solved in that world. We don't have much of a say in that, but I would say that the sort of characterization of this as being something as a sort of an odd thing. It's really been going on for 80 years. So I don't quite understand exactly why it's officially odd now, and it hasn't been for all that time period. The second part of that question is, I'll ask it a different way than it was asked, which is, what's going to be the best performing asset class over the next 5 years? Or I think that was more or less what you were asking. It's always hard to tell exactly what that will be, but typically, you have to have a view of the world, and I think our view of the world is that the economies of the developed countries are going to get hurt over the next year or so, and it ought to drive down asset values of a variety of types, and that there should be a great opportunity out about sort of a year to start buying companies and other types of assets at what should prove to be a bottom, and then if you can leverage those assets as the economy keeps getting better, you'll make really great returns. The last time this set of circumstances presented themselves was 2002, after the recession in 2001, which went into 2002, and we were the biggest purchaser of companies in the world in 2003 and 2004. And as a result of that, the fund that we used to buy those companies earned about 51% after fees, which for those who keep score of these things is really quite extraordinary. And we think that kind of cycle is going to repeat itself. So we would think that the private equity business, and you're seeing now, we were just involved with a deal that Professor Shiller mentioned. It was in the newspaper this week, I guess, where we were buying assets from Citibank, loans at discounts, and there will be opportunities in the debt area over the next year or so that also ought to be very good. Yes.
How did you feel about and how did you deal with failures in your investments, like your investment in the Argentinian software company? And how do you think that private equity will evolve in the future?
The question is, how do we deal with failure, like our Argentinian investment? And the second part of that was,
how do you think the private equity field is going to evolve in the future?
And how do we think private equity will evolve in the future? How do we deal with failure? I really hate failure. I mean, it's deep, it's visceral. I really can't stand it. And because I feel so passionately about that, the people who work at our firm, all of whom I've been involved hiring, understand how I feel about failure. And so we don't have a lot of people around who like failing either. One, because they don't want to disappoint me, but two, because I don't hire people who don't feel the same, right? So this is like a passion not to fail. So when we fail, it's a major, major, major event, okay? This is not a normal thing. And what we do when we fail is we spend enormous time thinking through, what did we do wrong? What should we have seen? Are our processes good? Did we misidentify a variable that got us? Or did we identify it and didn't evaluate how bad that can be? We got that wrong. Or did we just simply have bad luck where there are like 3 or 4 bad things that can happen? And they all happened, like in a very rapid period of time. And failure is how you manage failure is very important. And some people manage failure by making pretend it didn't happen, and they just go about their jobs and people don't pay attention. Well, we lost money on that one. I don't believe in that. I like to learn. Sometimes you learn more from your failures than you do from your successes. And we actually changed the way we made decisions at the whole firm after a very early failure that we had, and changed our whole investment process. And that one failure created most of our successes, right? So failure, when you make a lot of decisions, I used to think we could make no mistakes. And that's what I always try and do. But if you're very active in making decisions, I think about this stuff so much that we probably get about 90 to 93% of our decisions correct. Maybe a tiny bit higher. But that means we failed a lot, right? Sort of 7% failure. Sometimes we get 95% right. But we're still making 5% failure, across the firm. And so we're always struggling to improve and get that down to almost like nothing. And so, failure is a really important element in learning. It's like bad dating, right? You date somebody, it doesn't work out. That's the way, by the way, most dating is. It doesn't work out. Works out for a while, then it doesn't work out. And so all of you would probably think about, what did I learn from this? Why did I get involved with this person? Was this a good thing on balance or not a good thing? Am I going to repeat this mistake in the future? What did I learn, right? And that's what we all do in our own lives, and we do it in our commercial life as well. Second part of that question was the evolution on private equity. Private equity is an enduring asset class because it basically makes really great returns. It attracts very talented people. It reallocates capital around the globe. It goes where there's opportunity, and it improves companies by investing more capital in these businesses. And so there's an enduring place for private equity. Right now, there's a capital crunch, and there's not much money available to borrow except on smaller deals. That circumstance happened briefly in 2002. It happened 1990-91, happened 1987, happened 1982, happened 1975. So it happens. And when it happens, everybody always says, oh my goodness, this business is going away and so forth, and that never ends up occurring because capital always comes back. The evolution of the business will have a few super bracket kind of firms like ourselves who keep attracting more and more capital, who are investing globally, who have people all over the world, and the future for these kinds of businesses, I think, is pretty good, quite good. And you have smaller firms that are in individual countries, sometimes segmented by area of concentration. You'll have a healthcare group, and some of those businesses will do well, some will wither. You have smaller firms that do smaller kinds of deals. There's always a place for that. So I think that private equity tends to grow in step functions, as a function of how much money institutions have to put in the class. When stock markets go down and institutions generally have less money, they put less money in the class. When the markets get better, they put more money. So it's not a straight line of growth. It's a little wavy like that, and I think that will continue. I think we're done.